Welcome to the Business Short Course Series presented by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This course is an introduction to depreciation. First, what is depreciation? Depreciation is a way of spreading out the cost of a fixed asset, like equipment or a vehicle, over the years it is used. Instead of counting the full cost in the first year, we allocate part of it each year. This helps match the expense of using the asset with the income it helps generate, giving a more accurate picture of business performance over time. Depreciation is important because it helps businesses show a more accurate value of their assets on the balance sheet. It spreads the cost of an asset over its useful life, which helps match expenses with the income it generates. This approach also spreads out tax deductions over time, instead of taking one big deduction up front. Lastly, it helps with planning, making it easier for businesses to save for future replacements or upgrades. Listed here are 4 common ways to calculate depreciation. They include the straight-line depreciation method, which spreads the cost evenly over an asset's life. It's the simplest and most widely used method. The units of production depreciation method ties depreciation to how much the asset is used, like hours run or items produced, making it ideal for equipment with variable use. The double declining balance method accelerates depreciation, recording more expense in the early years. This is useful for things like vehicles or technology that lose value quickly. Fourth, the sum of the year's digits method is another accelerated method. It calculates depreciation using a formula that assigns more expense early on and less over time, balancing speed with structure. There are other ways to calculate depreciation as well, but they are not explained during this PowerPoint. When calculating depreciation, there are 3 key factors to consider. The first is useful life, which refers to how long we expect the asset to be productive and provide value to the business. The second is salvage value, which is the estimated amount the asset will be worth at the end of its useful life, what we might sell or trade it in for. And finally, the depreciation method depends on how the asset is used. We choose the method that best reflects its usage pattern and type, whether it's a vehicle, machine, or piece of equipment. Let's walk through how to calculate depreciation using the straight line method, which is the most common. The formula is depreciation expense equals cost minus salvage value, all divided by useful life. Here's a quick example. An asset costs $10,000, it has a salvage value of $2,000 at the end of its life, and a useful life of 5 years. So we subtract the salvage value from the cost, $10,000 minus $2,000 gives us $8,000, then we divide that by 5 years, which gives us $1,600 per year in depreciation. Depreciation affects all 3 main financial statements. On the income statement, the amount is recorded as an expense. This reduces the company's net income. Depreciation exists to spread out large expenses over time, which means the amount depreciated in any one year will be far less than the total asset cost. On the balance sheet, depreciation reduces the book value of assets over time, showing a decline in their net value. Assets are typically shown at their original value, less accumulated depreciation. Accumulated depreciation is simply the total amount of depreciation expense that has been recorded against an asset or group of assets since it was acquired. As more depreciation accumulates, net asset value decreases over time. Shown here is a depreciation balance sheet entry for company vehicles. The value of the vehicles has been decreased by the total amount of depreciation accumulated since the vehicles were purchased. When a fixed asset is purchased, the amount of the purchase will generally be recognized as a reduction in cash or an increase to a payable account or a combination of the two. The fixed asset will not be charged to expense at the time of purchase, but a portion of the cost will be expensed as depreciation at the end of each accounting period for the duration of the asset's useful life. IRS regulations govern depreciation for tax purposes, establishing useful lives of assets and approved depreciation methods. As depreciation is charged as an expense in future periods, there is no reduction in cash. Since depreciation does not involve cash, it's a non-cash expense, the depreciation amount will be added back under operating activities on the cash flow statement. Assets fall into 2 main categories when it comes to depreciation. Non-depreciable assets include things like land, which doesn't wear out or get used up, and inventory, which is meant for sale rather than long-term use. Depreciable assets are those that wear down or lose value over time. Examples include machinery, vehicles, buildings, office furniture, and electronics. Anything used in the business over a longer period. Let's do a quick review with a pop quiz. Question 1. Why is depreciation important? A. Assets don't need to be depreciated. B. Use of depreciation shows a more accurate asset value. C. Depreciation allows us to spread expense over the asset's useful life. Or D. Both B and C are true. Question 2. Which is the simplest depreciation method? Is it A. Straight line depreciation, B. The double declining balance method, C. The units of production depreciation method, or D. The sum of the year's digits method? And question 3. What factors are used in the straight line method? A. Cost, B. Salvage value, C. Useful life, or D. All of the above? If you need extra time to determine each answer, feel free to pause the video now. We'll show the answers in just a few seconds. Here are the pop quiz answers. For the first question, why is depreciation important? The best answer is D, both B and C. Use of depreciation shows a more accurate asset value, and depreciation allows us to spread expense over the asset's useful life. The answer to the second question, which is the simplest depreciation method, is A. Straight line depreciation is the simplest depreciation method. For the last question, what factors are used in the straight line method? The correct answer is D, all of the above. Cost, salvage value, and useful life are all part of the straight line depreciation method. To wrap things up, while depreciation might seem like just a technical accounting detail, it's actually a powerful tool. It helps businesses track asset value and plan ahead for major purchases or replacements. More than that, depreciation supports long-term financial health. It's not just about numbers. It's about making smart, strategic decisions that keep a business strong and ready for the future. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. I hope this gave you a clearer understanding of how depreciation works and why it matters for managing your business finances. We're here to help you make informed and confident decisions for your business.